Hey, this is Jason Hartman. Thank you for checking out this video. About 17 years ago, I made a very good decision, and I want to share it with you. It was one of my better decisions for sure. And that was when I became a nationwide real estate investor. I had always invested in real estate, purchased my first rental property when I was 20 years old. I was still going to college part time, and I did that and I invested in Southern California area. But I was not much of an investor back then. I thought I was. I definitely made some money, but what I realized after a while, after I got older and more experienced and had some ups and downs and so forth, that what I realized is that I was really a speculator. An investor is someone who buys properties that actually create income. And that's part of my 10 commandments of successful investing. And that's commandment number 5. Thou shalt not gamble. The property must make sense the day you buy it or you don't buy it. Well, how do you know? How do you know if it makes sense? How do you really evaluate that empirically? So let me share a couple of things with you, and then let's get into looking at every single number on a property pro forma that you should evaluate before you make a buying decision. And this actually works not just on your investment properties, but it can also work if you're considering a home for yourself. So either way, it can work on small properties, large commercial properties, single family homes, whatever. As you may know, I've invested in apartment complexes, big ones, small ones. My biggest was 139 units. I've invested in syndication deals that are even hundreds of units and bigger than that. But I like being a direct investor and I like being in control of the investments. That's really where I do the best. But as you know, with all of that experience and the hundreds of tenants I've had over the years, I like the good old fashioned single family home the best of all of them. So let's just kind of dig into a couple things that I think are really important here. First of all, if you have any questions, comments, or need assistance, we are here for you. Reach out to us. You can go to the website, reach out there. We're happy to help you. And of course, check out the terms of service and privacy policy. You know, I have been interviewing people on my podcast for the last 15 years or so. Before that, it was a radio show, so maybe 16 years. And I have interviewed thousands of fantastic guests, and I have learned so much from them over the years, whether it be the technical aspect of real estate investing or the very macro aspect, looking at the macro economy and so forth. And I've also learned a lot from you, from our clients, our software users. This is a picture taken at one of our live events in Newport Beach, California. So we learn a lot from you and all the stuff you teach us about investing based on the questions you ask, the experiences you have. And after doing this for so many years and having thousands of great clients, we learn a lot from those clients and the users of our software. So, one of the great decisions I made many, many years ago is this: standardize data. You must standardize your data. In other words, whenever you're looking at a property and you're thinking about buying a property, you don't want to have to be a detective. It's too easy to make mistakes when you are a detective. It's too easy to miss an important number, an important metric. It's too easy for the seller of that property to pull the wool over your eyes and really it's just too easy to make a mistake. So that great decision I made that I told you about at the beginning was that I decided way back in 2004 to standardize my data. I want to have standardized data. And that comes from this one document that you're going to see in this video that I'm going to teach you how to read. This pro forma document. It is a projection of 1 year of performance for a property. And so, what does that look like? What do the empirical, non emotional numbers look like when you are evaluating a property? Just to blow this up a little bit, this is how it looks. It goes through all of these numbers. It's not everything you need to know, but it is a fantastic start. There are still factors that aren't shown on the pro forma, right? There are still other things that you need to think about when purchasing a property, but starting with the numbers and mastering those numbers is a very, very important thing. Now, this is all generated from the property tracker software. It's very easy to do this pro forma. Maybe the first time you do it, it'll take you 15 minutes to put in the numbers. But the second time you do it, it'll take you 5 minutes. And the third time you do it, you could do it in 3 minutes. And it gives you this objective view of the very important numbers on that property and what you should be considering so that it's all in the same place. You learn how to read this one pro forma, and you will really be on your way to being a master of real estate investing. There's a lot to know. There's a lot to know always. There are a lot of experts out there. There's my podcast. There's my YouTube channel, etc. All of our courses and content that we have available to you. But the beginning, the foundational piece is standardize your data and learn how to master this one page pro forma. So let's dive in and let's take a look and let's review every number on this sheet. So the first thing you want to do is go to jasonhartman.com and click on the properties page. But also, here's another option for you. If you would like properties delivered to you in PDF visual format, delivered via podcast feed, I pioneered this whole idea, and everybody said it couldn't be done. You can actually subscribe to a podcast that is not an audio or video podcast. It is a PDF podcast that sends you PDF files right when they are uploaded with property pro formas, so they can get delivered right into whatever podcast application you're using. Just go to wherever you get your podcast and search Jason Hartman Property Cast, or just search Jason Hartman. You'll see all our podcasts, but pick the one that says Property Cast. Go ahead and subscribe to it, and these pro formas, like the one we're about to review and you're going to become an expert on here in just the next few minutes, will be delivered to you whenever new properties become available. Or, of course, you can check them at the website by, again, just going to jasonhartman.com and clicking on the properties section. And then you can go into picking any market and then any particular property, and let's look at a specific pro forma as an example, and let's go through analyzing every number on that pro forma. Again, this is so important to you as a good income property investor, because you are standardizing your data so that you don't need to be a detective. Every time you look at an investment, you can learn how to read this one page and easily become an expert on it, and you will know your numbers. So the likelihood of ever making a mistake in terms of analyzing the deal from a numbers perspective is extremely low. And again, these are static pro formas that we're looking at here. And if you want to actually manipulate the data, make changes, create new assumptions, new if-then scenarios, you can simply subscribe to the property tracker software, which is very inexpensive, and you can go ahead and you can create your own pro formas, and you can manipulate all of the data to your liking. Also, property tracker helps you track and manage your properties too. It's just a fantastic software. We've been using and recommending it at the time of this recording for about 15 or even 16 years now. So it's a really great tool. Okay, let's look at the pro forma and let's take you through all the numbers. So as we're going through the pro forma here, we see that this property is a nice looking home, and it's 1,400 square feet. Memphis home built in 1980, and some little information there. Initial market value is $82,000 and purchase price is $82,000. Now, one of the tricks I've seen a lot of promoters and a lot of groups play when they're looking at these pro formas, sometimes they use the same software we do, mostly they don't. One of the big things I want to caution investors for, and one of the first things I did years ago when I really got into nationwide investing, is I standardized the data. I'm a huge believer in data standardization, because then once you learn how to read this one-page pro forma that we're going to learn right now, you don't have to be a detective. You can find all of the basic information you need about at least the numbers side, the quantitative side of the property right here on this pro forma. So data standardization is absolutely critical. Now, one of the things I see a lot of promoters and groups doing that I think is really wrong is they will set the initial market value different from the purchase price, and that will make your return look astronomical. And even though some of our properties, I believe, are actually below market properties, I will not allow any of our local market specialists to represent the properties that way, because I think it sets false expectations. And besides, in our business, we're really in the business of cash flow investing, buying properties that make sense from day one, from the day you buy them. So it's not about appreciation for us. If appreciation happens, hey, that's great. It's icing on the cake. I'll take it. But I'm certainly not depending on it as a good conservative investor. So speaking of which, before I even finish going through this top part, let me scroll down here and let's look at assumptions. Assumptions is critically important because it drives a lot of the numbers on here. And you'll see we have the appreciation rate, the vacancy rate, the management fees, because all of these properties are including property manager fees. So you never get the midnight call, the metaphorical midnight call that, by the way, on my self-managed properties has never happened to me in over 20 years. I just must mention that. But you'll never get that because your property manager is managing the property for you, and the tenants don't even know who you are. And then maintenance percentage showing that we've got maintenance. So here are the assumptions that this pro forma is using to drive some of its stats. And we'll get back to that in a moment, but I just want to mention it now. We'll get back to why the assumptions are the way they are in a moment. So we've got the down payment. Now, here is the mortgage info section you see over here. Whoops. You see the mortgage info section. And this is, of course, subject to qualifying for the loan. But in this pro forma, we're assuming 20% down, 80% loan to value. So that would mean that you would need about $16,400 down. Then you have some closing costs. And I want you to note that closing costs will vary depending on your lender and the type of loan program you choose. So those vary, and those also have some impact on your interest rate, where it's really a game where the borrower can make the decision between, do they want a lower rate or a higher rate, and that will affect the closing cost. Talk to your lender for details on that, and of course we have lender referrals available for you as well. Now, if the property wasn't rent ready, if it wasn't a turnkey property, you see where it says other closing cost and fix-up cost. Here it says 0 because this is a turnkey property, so it's ready to rent the day you close on it. And some of our properties are even pre-rented, where there's a tenant already in them. But some are not, and so that varies. But this one, no fix-up cost. Occasionally, not often, but we have properties where the buyer does their rehab on the property, the investor does that after they close on the property. So in that case, it might show $10,000 in rehab or fix-up cost here. Okay, so total initial cash invested here is projected at just over $20,000, and that's based on qualifying for this loan. And the cost per square foot on this property, I always want you to look at cost per square foot because that's a really neat thing. You know that I talk a lot about something I call regression to replacement cost. In my risk evaluator, I talk about buying at or below the cost of construction. and why that's important, and basically getting free land in the deal so that you can minimize your risk. I don't like high land value markets at all. Those markets have proven historically to be very risky. And if at all possible, I want to buy below the cost of actual construction. We can see here that this property is only $58 per square foot. And I would venture to guess that you cannot build the property for that price, for $58 per square foot. It will probably cost you at a minimum, and this of course varies by area and construction quality and the builder and so forth, but at a minimum, you're probably looking at about $70 per square foot plus the cost of the land. So I like cheap or free land, and I like all of my costs to be in the improvement or the house sitting on the property, because that dramatically lowers my risk. For more on that, listen to the podcasts that I've done at jasonhartman.com or iTunes or Stitcher Radio, where I talk about how to minimize risk when investing. It took me 19 years to discover that, and it is truly new thinking in terms of investing, and I think it's very, very helpful. So monthly rent per square foot, that's kind of interesting. This one's projected at $16. However, we don't pay a ton of attention to that one. As we look down here, we can see that the projected rent on the property is $975 per month. Now the annualized numbers are here, but in commercial real estate, most investors talk about annualized numbers. And for some reason in residential, they mostly talk about monthly numbers. It all boils down to the same thing at the end of the day. And you can see the vacancy losses here. That's driven by the vacancy rate down here that we require our local market specialists to put in at least 1 month per year, or about 8%. So you see how we have vacancy losses. Then we have operating income. Moving down the sheet, we have property taxes, and again, these are estimates by the local market specialists. We make them put in all the data so that they're representing it. No one knows the market better than they do. But again, things can vary a little bit. So, we always recommend that investors ask a lot of questions, check things out. We teach a whole program on like due diligence and all of that stuff. That's not what this one is about. We're talking about how to read the performance, so I'm going to try and stick to that and focus on it. Insurance is performed at $37 per month. Management fees, now management fee is driven by the assumption here, which in this case is 8%. So 8% of your rent every month of this $975 totals $71. You see how that works? And then leasing and advertising fees and association fees, those are both zero in this case with this property. Maintenance is driven by the assumption down here of 3% per month. So 3% of your rent every month adds up to about $29 in maintenance fee. Operating expenses total, right there, $247. Going down, we've got our net operating income, $649 per month. We've got our mortgage payment. How is that calculated? Right here, it shows the type of loan that we're talking about on this property. And then we've got our cash flow here is positive cash flow projected at $296 per month, or almost $3,600 per year. Pretty darn good. Principal reduction. See, our tenant is paying off our mortgage for us every month. That's a beautiful thing. $80 per month paid by our lovely tenants, or almost $1,000 annually. And our first year appreciation here of $410 is driven by the real estate appreciation rate assumption at 6% annually. Now, if you look at appreciation rates historically, you'll see that over many, many years, 6% is about the commonly considered average. Of course, you can slice and dice this about 1,000 ways because it depends on the market. That's a national number. It depends on the exact period because it's an average. So if you average just the last few years, well, if you start at the financial crisis, that would have been devastating because real estate depreciated in some places a lot more than others. And then it started appreciating about I don't know, about 3 years ago or so at the time of this recording, and it's had some fantastic appreciation since then. And then, it depends if you look at new homes or resale homes and all kinds of different things. But generally speaking, the accepted number is about 6% annually. And look, keep in mind, we don't invest for appreciation anyway. We invest for cash flow. We want yield. It is all driven by yield in our mind, because being the conservative investor, you invest for cash flow. If you're a gambler, you invest for appreciation. Okay, so there we've got some additional numbers. Now, none of these, we don't pay too much attention to gross equity income. We're not going to address tax savings at all in this pro forma discussion today, because that's a fairly complicated issue. We have addressed it on many of the podcasts on the Creating Wealth Show at jasonhartman.com. So let's go over here. We talked about the loan assumptions. One thing I do want you to know is that interest rates for investment properties are a little bit higher than they are for owner-occupied properties, and we always try to get our local market specialists to be a little bit conservative on this number. In other words, estimate a little higher than it's probably going to be, but the interest rate varies based on the closing costs you pay and the type of loan you choose, and your credit score, your ability to qualify, etc. But just know that for investment properties, the rate is a little bit higher. Financial indicators. This is a very important section. I really want you to pay attention to this particular section quite a bit. So the first one is debt coverage ratio. With the debt coverage ratio, that's the number that had a lot of investors paid attention to it. The financial crisis, or at least the mortgage meltdown crisis, may have never actually happened. But investors weren't really investors, they were gamblers, and they were doing a lot of silly things. They weren't paying attention to debt, they weren't paying attention to income on the property, they were just investing based on the greater fool theory, and the greater fool theory goes like this. No matter what I pay for the property, some greater fool will come along and pay even more. That is not investing, my friends. That is gambling. That is speculating, and it's stupid. Okay, so don't do that. Let's invest. Let's invest conservatively. Let's invest for cash flow. Cash flow, pretty darn reliable. Appreciation, very unreliable, very, very fickle. So here you see the debt coverage ratio on this property is excellent. It's 1.84, meaning you have positive cash flow here of about $300 per month almost, or almost $3,600 per year based on this pro forma. And so that debt coverage ratio is excellent. You're very unlikely to get into any trouble with this property. You would have to have a lot of vacancy problems, collection problems, repair problems, be a bad landlord, have a bad property manager. You'd have to have a whole host of problems to mess this one up. So this property looks pretty darn good. Gross rent multiplier, both monthly and annual, we don't pay too much attention to that. Not really that meaningful. It is kind of a nice rule of thumb, but if you want to have a rule of thumb number, the one I would rather have you use is the RV ratio that I talk about a lot, or the rent to value ratio. So here, I always say that a good rent to value ratio is about 1% per month. So here we've got an $82,000 property, and the rent is projected at $975 per month. That's more than 1% per month, right? Because if it was 1% per month, an $82,000 property would rent for only $820 per month. And here, you're in pretty darn good shape. So I like this property quite well. 1% is ideal. Sometimes you even do a little better. Rent to value ratios are getting worse as properties appreciate, because remember, prices go up a lot faster than rents go up, historically speaking. So great property here. I really like this one. Now, capitalization rate, or cap rate as it's known, is commonly used with commercial real estate investors. I think it is a relatively flawed metric, because it doesn't take into account a couple very important factors. Number one, it doesn't take into account appreciation. And number two, it doesn't take into account leverage. Remember what that acronym, real estate is ideal? Well, the L in the word ideal stands for leverage, and the A stands for appreciation. Cap rate completely leaves those two very important metrics out. Now, the reason you might be asking, why is it such a big deal in commercial real estate? Why does everybody say, it's an 8 cap or it's a 6 cap or a 4 cap or whatever the cap rate is when they're talking about commercial real estate? Well, the reason I believe they say that is, number one, real estate in the commercial category does not appreciate as well as residential real estate. Why is that? Well, because it's based mostly on income. And I've leased many commercial properties over the years for my companies, and the typical commercial lease will include rent increases based on the Consumer Price Index, the CPI. And as you know, I believe, and many other people agree with me on this, that the CPI is understated intentionally by the government. Two major reasons for that. Number one, all the government spending and the government entitlement programs and the government employee wages and salaries are indexed typically to the CPI, the Consumer Price Index. So if that is understated, then the government can save some money. Number two, main reason, there are others, but big reason, is that they want to keep the populace happy. They want to keep the electorate happy. And if we believe inflation is really high, we're not likely to vote the incumbents back into office and let them keep their jobs. So they want to fool us into believing inflation is lower than it is. And they do this in many ways that I've talked about: weighting, substitution, hedonic indexing, etc. Lots of information on that on the podcast and at my live seminars. Okay, so the cap rate on this property is 9.5%. That is an excellent cap rate. On a commercial property, you typically wouldn't see that high a cap rate. Occasionally you will, but 9.5%, excellent cap rate, even though I don't really like the cap rate metric and I don't really pay a whole bunch of attention to it. It's okay, but it's limiting. One that I actually like better is this next one, cash on cash return. Cash on cash return is better because what it says is that as long as you maintain the same income and expense ratio on the property could go to 0 in value. It could be cut in half in value. This $82,000 property could be worth only $41,000, just half that amount a few years from now. But as long as you receive $975 per month, you maintain the same expense ratio, you are going to earn 18% annually on your property. That is phenomenal. Now, as I always say, even if it only goes half as well as projected, in this case, you're still going to get 9%. That's pretty darn good. The total return on investment, this is the metric that considers everything, and it's kind of debatable that it doesn't even consider inflation-induced debt destruction, which is another subject I've talked about in detail on the podcast. But this overall or total return on investment includes everything on the pro forma, and here you can see it's projected at 46% annually. Now you may be thinking, wow, really? This is too good to be true. Well, the reason that is possible, and the reason that income property, especially residential income property, has created millions of wealthy people and made lots and lots of money for decades and decades historically for people, is that it is a multi-dimensional asset class. And because it's a multi-dimensional asset class, unlike gold and silver that's just one-dimensional, you buy it and hope it appreciates in value, or stocks, most of which are one-dimensional, buy low, sell high, Dividend-paying stocks, two-dimensional, buy low, sell high, but also get some dividends in between. Income property is multidimensional in all of those ideal ways, okay? Income, depreciation, as a tax benefit, I mean depreciation, assuming you qualify for it, appreciation, equity, and leverage. So all of these great benefits are offered in a multi-dimensional asset class. That's why the returns can be 46% annually, they can be 20% annually, 25% annually, and even if it only goes half as well in this example, 23% annually, which I think would make most investors pretty darn happy. Anyway, a lot more information at jasonhartman.com and on the podcast available at jasonhartman.com or on iTunes or Stitcher Radio. So happy investing to you, and thanks for listening. I hope you agree with me now that standardizing your data is so critically important. You've got to standardize the data so you know what you're looking at when you're looking at a property. And it's so easy to master this one-page document. You can input these numbers yourself on a property when you use the property tracker software. Now, my real estate company, we have all these performas in a static fashion displayed on our website. So you can shop for properties on our platform in our marketplace and look at them. But if you want to put the numbers in yourself and adjust them and learn to play with them, you need the property tracker software. It's super inexpensive, very available, very easy to use. And again, I've been using it for a long, long time. And it's really how I became a much better investor, because I would start to see the relationships when I changed the vacancy rate assumption, when I changed the appreciation assumption. What if I bought a property below market? How does that affect the numbers? How does it affect the overall return on investment when I do this, that, or the other thing? And so really, really important to master this stuff. So go check out the software at propertytracker.com. Here's a quick little video orientation. I think it's just like a minute or so, and it will tell you what the software can do for you.
This is Dave. Dave has climbed the real estate property ladder to financial success. Rent checks are flowing in every month, and Dave has achieved financial independence. Maybe he'll go to Maui for some hard-earned rest and relaxation. Uh-oh. Maui will have to wait because Dave doesn't have the time. He has to manage his portfolio. He has expenses to track, documents to organize, tax schedules to create, property managers to manage, rental leases to track, and much, much more. This is Janet. Janet has all the time in the world. She has climbed the same property ladder as Dave and achieved financial independence. Cash is flowing in every month, but Janet can travel wherever she wants, whenever she wants. Janet is living the life. Although they are at the same place in their investment careers, Janet has a set of tools that allow her to live life to the fullest. Janet uses a powerful, multi-platform software suite to manage her portfolio. Janet uses real estate tools. Designed specifically for real estate investors, Real Estate Tools is a software suite that includes Property Evaluator, Property Tracker, and Property Fixer. Simply plug your numbers into Property Tracker and watch it optimize your portfolio's performance. You'll know which properties to buy, when to refinance, and even when to sell. No need to dread tax season anymore. Property Tracker has already created your Schedule E and depreciation reports. Simply email them to your accountant and you're done. Need a place to keep all of your documents organized? Upload them to the cloud where they will stay safe and secure. Now Dave can easily and effortlessly manage his portfolio from anywhere. Yes, even from that beach in Maui. And he has the time to do what he wants to do. Dave may even use his extra time and energy to continue investing. Watch him fly straight up that property ladder. Dave is headed to the top. Real Estate Tools, the ultimate portfolio management solution.
So I just want to wish all of you the very best. I want to say happy investing. Income property is the most historically proven asset class in the entire world. So take advantage of it. Build a great portfolio for yourself. Happy investing. If you need us, reach out. Our whole team is here for you, and we're always happy to help. Happy investing.